Hello and welcome to the Currency Exchange, NatWest Markets podcast on FX markets, where we break down the major themes and events driving currency markets for this week. Today, I'm joined by Galvin, Chia, our Asia FX macro strategist. We're going to look at China, the China reopening, and why investors may already be losing confidence. At the start of the year, the Chinese reopening was a big story among investors, and we saw a massive surge into Chinese assets and the local currency. However, investors already seem to be losing confidence and see both bond and equity market outflows. So, Galvin, what is the reason for this potentially bipolar behavior among investors? Are they already questioning this China reopening and its merits in investments?
Yeah, I think, Eimear, that's a really good question. So it seems like there really is, I think, in my opinion, a kind of a two-speed narrative going on here. Beginning of the year, everyone was underpositioned China, and the base for sort of the bar for supplies was so low, right? China was the last holdout in sort of that zero COVID narrative. After reopening, everyone rushed in, markets rushing to catch up and sort of move, sort of revise their views upwards. But I think, on the one hand, I think that's sort of that's run ahead of itself, because the actual economic changes, right, can't actually keep up with the pace, the day in, day out changes that the markets demand, right? So I think it's been kind of natural that some of that optimism has naturally pared back from, the sort of November, December euphoria, right? So I think from that perspective, a downward revision to that pace of optimism is probably a little bit warranted, right? And I think at the end of the day, like how much of that sort of additional pricing in of optimism is warranted, that big jump that we had at the beginning, that's over and done with. So I think from here, it's going to be a lot slower going. We've talking about, the end of that easy catch-up part is already here. I think you add on top of that, what's been happening in January and February. We've had increased global worries about the Fed, about U.S. inflation. I think overlapped as well with the sort of a dash of U.S.-China tensions, right? Who can forget, Balloon Gate or the hullabaloo is a nice one that I've seen. But ultimately, I think, all that aside, what we're seeing fundamentally from an economic perspective is that this growth story really still is unfolding. We're still in very early stages of that, right? So over the Lunar New Year, very strong activity. You mentioned just now, PMI data releases that came out earlier this week, and those actually surprised everyone, myself included, right? Those showed a very broad-based pickup in activity, a very broad-based pickup in optimism, and not just from the domestic side, but also from the sort of export order side. I think that was the most surprising as well. What was also particularly surprising for myself was, or rather encouraging from an economic standpoint, was housing data. We've sort of coming out of last year and the year before, the housing sector was identified as potentially one of the largest systemic risks to the Chinese economic superstructure as a whole, right? And that the housing sales data, housing constructions, housing prices all tanked last year. Those are double-digit negatives. But early housing sales data for February by a sort of a real estate sort of developer group, the top 100 real estate developers, the sales numbers actually flipped to about 15% year-on-year positive from, something like negative 30% prior, right? Obviously, it's a very low base. I think for me, that's still very, very encouraging numbers. It's the first steps towards what, is going to be sort of this bottoming out, the stabilization of the housing market. So I think all in all, it's not really a story about the recovery having stalled, about people, necessarily being suddenly sort of losing confidence. But I think it's the fact that markets can't necessarily keep up with the fact that reopening is going on, but it's going on at an economic pace rather than at a financial market pace.
I think we've definitely seen kind of that China sugar rush, and everyone kind of cried into those positions. What do you think they need to get back in for us to actually see further inflows?
Yeah, I think that's actually a really good question. So my sense initially was probably you need a little bit more of the data, right? Markets have been sort of in this hyper-vigilant, data-dependent mode, whether it's for the US, whether it's for Europe, and I think that's definitely going to be the case in China. One of the biggest, in my opinion, one of the biggest gaps in that, right? The reason for that sort of lull in expectations positioning aside, has been the fact that Chinese statistical agencies aggregate January and February data. So between the data for December coming out in January and the data for January and February coming out in March, that's a 2-month window of no official data releases, right? So you think that the Fed's blackout period can be bad. You think 2 months here of, no retail sales, no export data, no industrial data, that's a long wait. So I think markets are probably going to really want to sink their teeth in to anything they can get come mid-March when the data comes out.
I admit it's such a good point. I think investors want reassurance, right? They want to know what's going on. So 2 months without having, a read on the economy is a long time when you're holding a position. Exactly. I also have to ask you, it is obviously the big National People's Congress this weekend. What are you watching? What do you think, could be a pivot point for markets?
Yeah, I think that's it's always a little bit hard to tell, because with these sort of big edifices of the government, of the Communist Party, it's very difficult to distinguish what might move markets and what's more important for the longer term. So going back to this Twospeed analogy with China, I think that's definitely the case. Chinese policy tends to be implemented over the course of 1 year, 2 year, 5 years. They play the long game. Right. And what's going to come out of the National People's Congress is, I think, the markets will have to sort of sift between what's relevant for now, what's relevant for this year, and what's relevant for, politics, what's relevant for the messaging and the imaging about what China, the sort of, how can we scrutinize the minutiae and read between the lines of the Chinese political edifice, right? So a lot of different things for a lot of different types of people. So for us, right, I think what's really important is a couple of things. So the first thing is policy targets. I think the main thing that's going to come out of this big 2-week bonanza are policy announcements. These have already been decided, and this is where they're presented and sort of move through the legislature for without usually any objection. But these are things like the GDP target, which I think will be very important, and of course. In China, it's well known that GDP is typically, the GDP target rather, is an input to economic activity rather than an output. So the GDP target is decided first, and sort of the governments and state-owned enterprises typically then try to work towards achieving the target. So I think in this year, where the return to growth is going to be a huge theme, the GDP target is probably worth watching. In my expectations, it's probably going to sit at around 5.5%, which I think has been sort of pretty firmly the market expectations coming out of last year as well. The other interesting thing that's going to be, I think, a close watch is sort of the politics around leadership and economic portfolios. In particular, this idea of, who gets the premierships, right? Who helms the PBOC, who helms the regulatory agencies. A little bit of sort of scrying sort of the party ranks and scrying the government bureaucracy about, what are these figures going to look like? Are they going to be as market friendly and as well known and as presentable to international investors as the previous generation were? Or are they going to be sort of inscrutable as sort of party apparatchiks as some of the sort of more conservative or some of the more sort of downbeat assessments might have it, right? I think that's going to be something quite interesting as well. Other things that might be interesting, I think, would be anything else that's coming on the property market. So far, there's been a lot of stimulus and sort of the government loosening a lot of restrictions on the property market since late last year. But I think it's always, given the property market is such a large part of China's economy, and given that it was such a key sort of point of weakness in the economy, anything else to think about stimulus, stabilization, and the direction of travel for that is going to be important. It's also going to be important because the size of China's property market has very far-reaching implications for the rest of the world. Commodity demand, questions about inflation, all inevitably feed back, in my opinion, a little bit, to this question of what's going to happen to property. And I think lastly, there's this idea that the government has been talking about restructuring its a lot of its organizations, right? So this tends to happen, I think, roughly every 5 years or so. Some of the sort of more well-informed analysts have said. But I think, some people are questioning, is this going to be more market-friendly, more sort of efficient in a way? Or is this really going to be a sort of centralization of power? I think that is a bit of a is a question on a lot of people's minds. But I think ultimately, the bias to me does seem that the government is committed to delivering, a growth-friendly, market-friendly, economic development-friendly policy tack already this year. So perhaps, that's less of a risk that we get a swing towards political centralization and away from sort of the market side.
I guess there's a lot of things going on within, the Congress. What are, to play devil's advocate, the biggest risk for, positive risk assets on the back of this meeting and the biggest potential boost?
Yeah, so I think, perhaps the biggest risk is that if they send this message and the markets take it badly, that it's going to be politics. It's going to be about regulation. This reopening was a bit of a head fake, and it's really about reasserting the centrality and the authority of the government and of the Communist Party. I don't think that's something that's going to be happening. But as we saw coming out of the party congress last year in November, that's the way the markets took it. The markets reinterpreted President Xi's third term as one of centralization of power and sort of increased political risk. And that fueled sort of the risk premium in China fairly significantly over the preceding and proceeding a couple of days and weeks. I think the big sort of upside risk factor would probably be, if they come up really hard and say that they want to really start loosening the taps on stimulus. Typically at these sorts of events, they don't really say things, I think, with that much sort of clarity. They're vaguer than the central banks tend to be, right? But I think if there's a hint that it's business as usual, they're trying to welcome back charm offensive, that's going to be probably the risk positive case. Perhaps the middle of the ground one which is kind of interesting, would be if the government sort of decides to say, hey, the recovery is actually going quite well on its own and we don't need to stimulate as much. That could be in a sort of interesting middle ground that could be a little bit confusing, but I think could sort of trigger a little bit of a rethinking about how much the government input will be able to sort of stopgap the growth outlook for 2023.
And on that middle ground outcome, do you think CNY trades lower?
Yeah, I think it's a little bit difficult to say. I think on that middle ground, yeah, perhaps CNY does trade a little bit lower, but I think overall, my sense is that the growth outlook and CNY haven't actually been very closely correlated. My thesis has always been that you get a sort of either a political shock or some sort of quick repricing that has the ability to sort of move the currency in sort of a step function. But otherwise, it's shown kind of a tendency, in my opinion. If you look at sort of if you plot the returns of CNY against the returns of something like Eurodollar, those have actually started correlating, those have actually started moving together again after sort of last November, right? So in my opinion, it's sort of like, yeah, it'll take a positive or negative growth shock or political shock for CNY to sort of really be to move to its own tune. But otherwise, I feel that there's a lot to be had about where the Fed goes, where the dollar goes, where the euro goes, and the like.
Loads of potential different outcomes coming out of this, but I have to ask, what is our base case? Are you still bullish on China, even with these kind of equity of bond market outflows that we're seeing?
Yeah, definitely. So I think it's still the case for China, for Chinese growth, for Chinese recovery, still very much there. I'm definitely one who is bullish on the growth outlook. I think if anything, growth might surprise higher. But I just think that this is something it'll take time to play out, unfortunately, right? It's a multi-quarter theme rather than something we'll see, in immediately before the end of Q1 or Q2. And again, it's a question about reconciling those sort of two-speed mindsets, right? The economic mindset and sort of maybe the financial market mindset. I think that for me has made it a little bit difficult to think about how that might best play out in FX or rates. For FX, I've still kept my sort of baseline target of CNY moving to 668 by year end. So from right now, it's about 690 down to 668. perhaps a little bit smaller move than what we saw coming in from sort of November into December. But I think that's generally the currency has tended to trade with sort of lower volatility than it has last year. But I think ultimately, right, next year is going to be one about multiple transitions, which makes it quite interesting. I think on maybe on a deeper sort of sectoral level, if one were thinking about equities, I think this would be a very interesting time to think about relative equity sort of allocations, right? It's a transition out of zero COVID. It's a transition towards more consumption. It's a transition towards, trying to localize high tech and sophisticated manufacturing. There's the energy transition, of course, and of course, externally there's a pricklier geopolitical environment. So I think all of that sort of domestically makes for some very interesting, I think, food for thought about how that's going to play out in terms of local domestic allocations and how foreigners might allocate into the local markets as well.
Yeah, I think it's interesting that kind of different equity allocations you could see, but also because it has this a regional impact across Asia. How do you think, the new growth that we could see from China will benefit and potentially hinder some Asian economies?
Yeah, definitely. I think that's a really good point. And I think that's really important because everyone's always thinking about China as the biggest, fill in the blank, right? The biggest country, the biggest consumer market, potentially the biggest energy consumer, the biggest exporter, right? It's so important and so integral, a trading partner for so many countries around the world. I think for the region, most clearly, the quickest thing that we'll probably see is obviously like the tourism returning and that helping buffer some of the buttress some of those that are very heavily reliant on Chinese tourism. Thailand is the prime example, but the likes of including places like Philippines and where I am, Singapore as well, stand to benefit as well. The other one I think is commodity demand, right? I think a commodity and manufacturing demand, given the Chinese domestic demand is going to be rising. China tends to be a little bit more self-sufficient than it is in terms of its domestic demand that it is compared to one in terms of its when thinking about its role in global supply chains. But I think if Chinese demand does pick up a little bit, countries that feed some of the components for Chinese domestic demand can benefit as well. Notably, the semiconductors and story is probably going to play out as well. I think ultimately, though, what really strikes me is the fact that Chinese growth on the uptick, combined with the fact that in the Asia Pacific region, right, or rather in sort of emerging Asia ex Japan, none of these countries, even from the beginning of the year, none of these countries have been talking about recession. So that, I think, in comparison to the woes that are being faced in the developed markets, the woes that are being faced in Eastern Europe or the Middle East, Africa, that makes it really interesting for me. So it's not just a China story, but it's a broader, I think, Asian resilience story that will come to shape 2023.
Yeah, I guess we're seeing very different kind of regional divergence coming through. Because in my region, 2 out of 3 CE economies that are already in recession. So just kind of clear, hopefully, opportunities within emerging market currencies. Galvin, have to get your final word on the big debate, which is raging among economists. China reopening, is it inflationary or disinflationary?
You've cornered me there, Eimear. I think it's going to be net inflationary, but I don't think it's going to be anywhere near as inflationary as what we've already seen in 2022. So perhaps, the idea that might keep things a little bit firmer, if anything, but not anything that's going to cause a huge spike. Definitely, that is a note that is under construction on my part, but, perhaps with luck, that'll be out soon as well.
Actually, there will be a lot of feedback into certainly something that is divided at markets and economists. Guys, that's about all your time for this week's episode. If you like the episode, please do hit like and also do subscribe so you'll get our next edition at the earliest. Thanks for joining us.